And in the second kind of situation, which is when there's no dissolution. So which are the cases if an acquirer acquires more than 50% of the voting stock of the acquiree, or the acquirer gain control through ownership of variable interest. In both of those situations, none of the firms are dissolved and both firms survive. So what do we do under this situation? For example, we have two firms, firm A and firm B. A obtained control over B and both of the firms survive. And here we're also interested in what should we do on firm A's book? What should we do on firm B's book? What should we and credit consideration transferred at the fair value of the consideration transferred. Also, credit gain on bargain purchase if the consideration transferred is less than the fair value of firm B's net asset. So here, I guess that in this journal entry, what you should pay attention here is so we have three situations, right? Three sub-situations. The first situation is the amount the consideration transferred is exactly the same as the fair value of firm B's net asset. So in this situation, we debit investment account, credit consideration transferred. And then the second situation is when the consideration transferred is more than the fair value of firm B's net asset. And in this situation, we do the same. So the difference, which is actually the goodwill, whatever the additional amount the firm is paying is actually the goodwill. And in firm A's book, we do not recognize goodwill directly. We still make the same journal entry, which is debit investment account, credit consideration transferred, at the fair value of the consideration transferred. And then in the situation 3, when the consideration transferred is less than the fair value of firm B's net assets, here we debit investment account, credit consideration transferred, and in addition, we also need to credit gain on and as an acquiree, firm B does not need to do anything. It just keep operating and do its financial recording the way it used to be. And it didn't need to worry at all about this merger. So nothing need to happen from B's book. And then at the end of the financial reporting period, what we do is that we take from A's book, we take from B's book, and then we make some consolidation entries, which is to adjust some of the accounts. So when we take from A's book and add from B's book to it, some of the accounts are actually repeated. So we use those consolidation entries to eliminate those redundant accounts. And then after the consolidation entries, what you are going to get are your consolidated total numbers. And those consolidated total numbers are what are reported to investors. So as investors of the firm, you actually, if your firm is if the financial report you get is a consolidated financial report, it just means that the numbers you are seeing are consolidated numbers. It is either you're not going to see those numbers either from A's book or from B's book directly. It is from A's book plus from B's book plus some adjustment. And those are the numbers you see. And then there's something to pay attention here is so when we do the consolidation for firm B's income statement account, it is only consolidated for amount after acquisition. So this should make sense, right? Whatever income firm B generates before the acquisition, it does not belong to the combined firm as a whole. So we should not include those income numbers. But for firm B's balance sheet, we just consolidate because balance sheet is a balance. So we need to consolidate the whole amount. But for income statement, we only consolidate the income which is generated by firm B after the acquisition. And then what do we do going forward? So going forward, both firm A and firm B each keep its own book. So firm A keep making its keeping its own book. Firm B keep its own book. And consolidation is done periodically on the consolidation worksheet. So which means that every period going forward, we need to go through this process again and again. Each firms survive. And then I'm just going to take some time to talk more about this second situation when there's no dissolution. So first, let's look more at on the date of acquisition, what happened on the consolidation worksheet. So on the consolidation worksheet, as I said, we take from A's book, and then we take from B's book. We make some consolidation entries. Specifically, what consolidation entries do we make? So we're going to talk about a lot of the other consolidation entries later, but on the as the very basics, let's just start from talking about what consolidation entries should be made on the date of the acquisition. So on the date of the acquisition, we have two consolidation entries, consolidation entry S and consolidation entry A. What is consolidation entry S? S stands for shareholders' equity. So what consolidation entry S does is, S is trying to help us eliminate subsidiary or acquirees shareholders' equity account. So the general entry is, if B is the acquiree, is the firm that is acquired, the general entry is, we debit firm B's shareholders' equity account at its book value and credit investment account for the same amount. So this is consolidation entry S. And then consolidation entry A. A stands for allocation. So what we do through consolidation entry A is, so if you still remember from we have kind of mentioned, an acquisition, what is paid by the acquirer is called consideration transferred. And then the acquiree has a book value. So the difference between consideration transferred and the book value of the acquiree, that is the excess that is paid. And this excess, it is made up of the acquiree may have fair value more than the book value. So for each of acquirees identifiable asset and liability, we may, at the date of acquisition, we need to before the acquisition, we need to revalue the acquirees, all of its identifiable asset and liability to its fair value. So we have a difference between fair and book value here. That may be part of the reason the acquirer is paying more. And another part, maybe the acquirer is paying more for some other reasons that we cannot identify, and that is called the goodwill. So entry A, allocation, is basically when we combine firm A and firm B's book, firm B's book is still at the book value. So we use consolidation entry A to try to revalue firm B from its acquisition date book value to its fair value. So what we do here is we debit firm B's asset at the difference between fair and book value. Why is it the difference here? Because we already account for firm B's, the whole firm B's book at its book value. So we don't need to double count by debit firm B's asset just as fair value. We need to take out the book value here. So this is just to mark up firm B's value from its book value to its fair value. we debit B's asset at the difference between fair value and book value, and we credit firm B's liability at the difference between fair value and book value. And then if there is any goodwill, which is generated from this acquisition, we debit goodwill account. So we also acknowledge that during the merger, firm B's value includes a part that is belongs to goodwill that also has value. It's just we cannot identify it. We cannot allocate it to any identifiable asset or liability. We just knock them all up and call them goodwill. So, and then this goodwill is the difference between consideration transferred and fair value of firm B's net asset. And then we credit investment account correspondingly to make this journal entry balance. So this is the what we do on the consolidation worksheet on the date of acquisition. And then for the no dissolution situation, there's a question I want you to think about. After consolidation, so after all that we have done on the consolidation worksheet, what would be the balance of firm A's investment account? Please take 5 minutes to think about this question. What would be the balance of A's investment account after all of the consolidation entries? So firm A's investment account will actually be 0 after all of the consolidation entries. Why? So we have firm A's investment account. It begins with a 0 balance. And if you think about on the date of acquisition, what is the first thing we do? So we need to make a journal entry of firm A's book, right? So A's entry. And then depending on the situation, so we're either, if we're paying, if the consideration transferred is the same as, fair value of firm B's net identifiable asset, then the investment account will be increased by the consideration transferred because the journal entry we make is to debit investment, credit consideration transferred. And then if in the second situation, such situation, when consideration transferred is less than the fair value of firm B's net identifiable asset, the investment account is actually increased by consideration transferred and also increased by gain on bargain purchase. Right, so because the journal entry in the third situation is to debit investment, credit consideration transferred, and credit gain on bargain purchase. So this is A's journal entry, what A does on its book. And then consolidation entry S. So consolidation entry S, no matter which situation it is, consolidation entry S is the same. The purpose is to eliminate subsidiaries shareholders' equity account and then to credit investment account correspondingly. So investment account here is decreased by the book value of firm B's net identifiable asset. This is consolidation entry S. And in consolidation entry A, what we do is we are trying to mark up firm B's book value to fair value and to recognize any goodwill if there's any. So if it is the first situation, when the consideration transferred is the same as the fair value of firm B's net identifiable asset, the consolidation entry A is we need to debit all of firm B's assets at the difference between fair and book value, credit all of firm B's liability at the difference between fair and book value, and credit the investment account correspondingly. There's no goodwill here. So investment account is decreased here by the difference between fair and book value of firm B's net identifiable asset. And if it is the second situation, when there is goodwill, the investment account, we need to take into account goodwill here. So the investment account is decreased by not only the difference between fair and book value of firm B's net identifiable asset, but also goodwill. And if it is the third situation, when we are paying less, so here it is the same as the first one. We only mark the firm up because there's no goodwill in this situation. So we mark the firm B up by the difference between the book and fair value of its identifiable asset. So investment account correspondingly will decrease by the difference between fair and book value of firm B's net identifiable asset. So these three situations, if the first situation, those two book value cancel out, and then we are going to have the difference between consideration transferred and fair value of firm B's net identifiable asset. And then, so as you can see here, the first situation, by definition, it is the situation when consideration transferred is the same as the fair value of firm B's identifiable as net identifiable asset. So this difference will be 0. And then if it is the second situation, book value cancel out. So we have consideration transferred minus fair value plus goodwill. Oh, sorry, minus fair value and then minus, because this is minus plus, so it is minus goodwill. And then the second situation, by definition, consideration transferred should be equal to the fair value plus goodwill. So this will be 0 as well. And if it is the third situation, book value cancel out. So what we have is consideration transferred plus gain on bargain purchase minus fair value. And the third situation, by definition, consideration transferred plus gain should be equal to the fair value of firm B's net identifiable asset. So this should be 0 as well. So as you can see that no matter which situation it is, after consolidation entry S and A, your investment account should always go to 0, which just means that actually the purpose of consolidation entry S and A is to bring the investment account back to 0. And yeah, so every time after you have done the consolidation, please check your investment account. It should go to 0. If it is not 0, that means there's something wrong with your consolidation. So that is about the investment account. And there's another question I want to mention before we go to each of the specific dissolution versus non-dissolution situation. So this point is actually pretty important here. No matter whether it is the dissolution situation or the no dissolution situation, both situations will give us the same consolidated total numbers. So no matter whether the firm, no matter what form of business combination it is, actually the consolidated total numbers the investors are going to see will be the same. So why is this the case? Please take 5 minutes, think about it. So why would both no dissolution and dissolution situation give us the same consolidated total numbers? Let's first look at no dissolution situation. In the no dissolution situation, what we do is we take A's book and we make an entry on A's book. And then we add from B's book. And then we add consolidation entry S and then consolidation entry A, right? So this is what we do. And what we do by the entry from A's book, the entry is we debit investment account, credit consideration transferred, and credit again if there is any gain on bargain purchase. And what what we do on firm, we add firm B's book to it. And in essence, what we are doing here is we're debiting all of firm B's asset at the book value of those assets. And we're crediting all of firm B's liability at the book value of those liabilities. And we're crediting firm B's, all of firm B's shareholders' equity at the book value of those shareholders' equities. So this is in essence what we are doing by add firm B's book. And then we add consolidation entry S. So consolidation entry S, we use it to eliminate firm B's shareholders' equity account. The entry is to debit firm B's shareholders' equity account at its book value and credit investment account correspondingly. So at the book value of firm B's net identifiable asset. And then we add consolidation entry A to mark up firm B's book value to fair value. So consolidation entry A is to debit, is to debit firm B's asset at the difference between fair and book value. We debit goodwill if there's any. Credit firm B's liability at the difference between fair and book value, and credit investment account correspondingly. So this investment account, it is either equal to the difference between fair and book value of firm B's net identifiable asset, or we need to add goodwill to it if there's any goodwill. The amount we credited in the investment account. So this is what we do under the no dissolution situation. And as you can see here, consolidation entry S eliminates firm B's shareholders' equity account. And then the investment account, as we just said, so if you do not remember, just refer back to the previous slide. The whole previous slide was to explain why the investment account will be eliminated after the consolidation. And then, so investment account is going to be eliminated. So what do we have? What do we have left? We have firm B's asset at book value. We have firm B's asset at the difference between fair and book value. So we have a debit of firm B's asset at book value plus fair value minus book value. So what is it? It is just at fair value. And then we have firm B's liability at book value, firm B's liability at the difference between fair and book value. So what do we have here? We have B's liability at book value plus fair value minus book value, and book value cancel out. So what we have left is the fair value. And then what else do we have here which hasn't been eliminated? We have goodwill. So if we are paying more to acquire the firm, then more than fair value of the firm's net identifiable asset to acquire the firm, the difference is goodwill. So we have goodwill here. And we also have credit consideration transferred. And if there is any gain, we need to recognize gain on bargain purchase. So as you can see here, what is this journal entry? So this journal entry is exactly the journal entry we make under the dissolution situation, right? So as you can see here is actually in essence, even though we are using the dissolution and non-dissolution situation, we're kind of doing very different things, but the results are exactly the same. It's like for the no dissolution situation, we're just breaking down this journal entry because under the no dissolution situation, we need to keep firm's book untagged. So that's why like we're kind of using consolidation entry S and A to try to bring it back as if it is the same as the dissolution situation. So both situations will give us the same consolidated total numbers. So this is just an abstract overview of what we do for the acquisition method and the different situations. And then we are going to look at some specific examples for each of the situation.